Good afternoon and welcome to Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at MarketSite is Englebert. He's Managing Director of Beirne Wealth Management. Thank you very much for joining us at MarketSite today. And I'm excited. It's our monthly Registered Investment Advisor update. And this time we're going to focus on, it's not just isolating yourself to your clients, but it requires a network to properly manage someone's portfolio. And we're going to focus on CPAs today and your top 5 steps for working with CPAs.
Yeah, Jill, thanks for having me. A lot of people, a lot of investment advisors, when they start working with CPAs, they think of it as the holy grail because CPAs have clients. And one of the things that we try to identify right off the bat is whether or not a CPA firm is also an RIA. So we're a registered investment advisor. Many CPAs have formed their own registered investment advisors. So we tend to shy away from them. And in fact, it's very interesting how there's a big delineation among CPA firms. Some of them embrace having an investment arm. Others want to keep that at arm's length. So we obviously focus on those that are what we believe are truly independent.
And you said for the second one, expect nothing.
Yeah, there's a lot of marketing out there for advisors to go out and create relationships with CPAs, and they tend to be very aggressive when they do that, and they'll call up a CPA and say, hey, Englebert here with Beirne Wealth, we'd love to refer some clients. Do you refer any clients back? You can't be that up front. You've got to be, it's much more of a consulting and problem-solving relationship in the end.
Why do you suggest finding mutual clients?
Well, what we do in our practice, in fact, before I came here today, we had a situation where a client called me up, said, hey, my CPA needs some last-minute tax information. I thought I gave it to him. I didn't. We know who the CPA is. We have obviously written authorization from the client, but we immediately forward the tax documentation to make the CPA's life as easy as possible. So we, in our practice, go through our entire book of clients and find out who their CPA is and do we have any mutual clients between the two of us.
And the fourth step is off-season?
Yeah, we call it the off-season. Obviously, these guys and gals are up to their eyeballs in tax returns right now, going 110 miles an hour, working 7 days a week. And so what we end up doing is after they decompress, usually about the middle of May, we start doing our Friday lunches. We call them up, we invite them into our office, we get to know them and their practice. We also have them know what our practice is and what we specialize in at our practice.
All right, and the fifth step is including CPAs in your marketing process.
Yeah, absolutely. They're a center of influence, and one of the unique things that we do around tax time is we put together a CPA relief basket that we send out. It has coffee in it, it has our mugs in it, it has Advil in it, it has eye drops, etc. And it creates interesting conversations because they get this basket, and it's amazing how many of them call us right away and thank us for it. But it creates an interesting conversation where we're in the forefront of their mind because when they're problem solvers too. I've been in many meetings where CPAs get very excited when you call them in the off season and say, listen, we both have XYZ client. We'd like to do a strategy session and talk about better ways to save the client taxes. Their eyes light up. It's much more interesting for them from a strategy standpoint.
Speaking of helping to resolve problems, you always say show your specialty, and part 2 of that is to help resolve problems.
Yeah, in our shop, we specialize in small company 401ks, between 20 and 80 participants. And what ends up happening is a lot of these CPAs do obviously business returns, and they have business owners. And they will have a comment made to them, hey, we're unhappy with this, or we need to do something like that. We had a really good situation where it was a very small company, 3 individuals, and we got on the phone with their CPA to talk about how putting in a small company 401k could really maximize the tax savings for the client. And the CPA was all behind it, and they were very glad that we'd recommended something like that.
So it's almost like when you're investing in a portfolio, sort of stay in your lane. Like this is what you're good at, this is where your area of expertise is. It wouldn't even make sense to approach a larger pension fund if that's not where your area is. And so there is specialties within the RIA community.
Yeah, absolutely. I mean, you really have to focus on your niche. And I also think that helps your advisory practice as well, because if you're trying to be all things to all people, you may not end up being anything to anyone.
All right, well, let's go into our second segment. This is about leveraging your 401k. Very topical at this time of year as people are allocating their retirement money with taxes coming due on April 16th, right? Because that's on a Monday. So let's take a look at this chart here, and it really shows the power of leveraging your 401k.
Yeah, the good news this year is that we've seen the amount that you can put in your 401k go up. Anybody under the age of 50 can put in $18,500. Anybody over the age of 50 can put in $24,500. But I think it's a timely topic right now because people are doing their taxes taxes, and they may be upset that they paid too much in taxes in 2017. And it's a good time to review your 401k, because the easiest way to obviously save on taxes is to contribute more to your 401k.
Right, plus you don't even feel it because it comes out of your paycheck.
Correct.
And another great piece of advice too is take it up 1% each year.
Yes.
You won't notice the difference.
We've run numbers. We actually have a special software that we run for participants, and I've run it hundreds of times, and it's amazing, Jill, to see that just putting an extra 2% in a year can literally mean tens of thousands of dollars when you go to retire.
Let's talk about asset allocation and target dates, and this is a question I'm sure you've gotten a lot over the past couple of weeks as people are moving their retirement money around. For example, I went from contracting to full-time, so I had to make that switch, and I'm thinking to myself, there's a little bit of volatility in the market this year. Is it, should I leave it? Should I perhaps put it into a fund? How do you talk to clients and go through that asset allocation and target conversation?
Yeah, with our clients, we obviously get their lineup if they're in a 401k. If they're not with us, if they're with another company and they're doing their 401k, we review what their fund lineup is. One of the things that I want to really point out is that a lot of people have done the fire and forget it with target date funds. Target date funds have been all the rage the last 10 years. If you would see the tens of billions of dollars that have come into target date funds, it's truly amazing. Now, we're putting a cautionary tale out there because a lot of people say, well, I'm in a target date fund, I'm going to be okay. Well, you have to really look at the asset allocation in a target date fund. So obviously, if you're a younger person and you're retiring in 20 or 30 years, you've got to realize that you have a heavy equity exposure in your target date fund. The other thing that concerns us is that if you look at many older participants, a lot of them get lulled into a false sense of security and they just look at rates of return, and they may be in an inappropriate target date fund. Many target date funds have heavy equity allocation, and with the volatility that we're having right now, people could end up being in for a surprise when they open their first quarter statement.
All right, well, speaking of vol, let's take a look and do our chart review as we do each month. This first quarter certainly looks different than 2017 looks. So if we take a look at the 3-month on the S&P 500, definitely different if you're comparing that to what 2017 looked like.
No question about it. Last year was a one-way market with little price discovery, or actually the only price discovery was on the upside. Here we come rolling into 2018. It's been quite a shock to the system. We peaked January 26th. We saw over a 10% correction, followed by a rally, followed by another possible retest of the lows. But then in the last couple of days, you've had the market rip higher by over 1,000 points. We're still cautious at our firm. We don't believe things are over quite yet, and we're trying to have people obviously examine their comfort level with the market with this kind of volatility.
I mean, 2017 was an anomaly, though. It is unusual to see a market go from the bottom left to the top right on the charts with not even a 1% move, I don't believe, for the entire year. But I also don't think it's normal for the market to have 400, 500, 600 point swings in one session either.
Yeah, you're correct. I mean, again, volatility, we've gone from little volatility to tremendous volatility in a short period of time, and many investors don't know how to cope with this. Unfortunately, I've been around a long time, so I've seen a lot of volatility. Typically, changes in volatility signify changes in market direction, and that's what has us cautious right now.
All right, and let's also take a look at the 3-month on the Nasdaq Composite, and that's really where the leadership has been through 2017, so it's different to see how that composure has shifted as well for the first quarter.
Yeah, there's a big question whether or not the FANG trade is done. Facebook, Apple, Amazon, Netflix, Nvidia, Google. Some of those stocks have seen tremendous volatility in a short period of time. This is we feel it's a very similar market to 1999, 2002, and that there looks like there's going to be a possible change in leadership, from that one-way trade that we saw the last couple of years.
Right. Well, I mean, sector rotation is also part of how the markets function as well. So I don't think it needs to get necessarily that overblown, but it's the Russell. If we take a look at the Russell 2000, and this is just for a 1 month, does that tell you a different story?
Well, it's interesting. The Russell 2000 is showing kind of a different picture. The bulls are saying, hey, look at small mid-cap stocks and how well they've held up. The bears are obviously focused on the FANG trade and showing how that's broken down. So we really have this bifurcated market, something we really didn't have last year. But to your point about sector rotation, it looks as though sector rotation is going to be really the key for 2018.
All right, and to wrap up, the 10-year, that's been really what's driving the headlines as well.
Yeah, everybody's worried about higher rates. We saw the 10-year peak at 296. It's floated back down. The fear trade comes in. Interestingly enough, Typically, when you have a lot of market volatility, we'd expect to see interest rates much lower as people go flying into bonds as far as safety goes. The fact that they haven't does have us a little interested as far as maybe interest rates are the most boring asset class this year. They've peaked and they really do nothing as far as up or down for the rest of the year.
Are you surprised to see how the overall market is so sensitive to headlines? Because that
Yeah.
seems to be where the volatility has been generated from.
Yeah, we're in that no man's land. I mean, we have earnings starting next week. We think that's going to give some clarification, but we've noticed the 3 or 4 weeks between earnings, usually the headlines really drive what's going on in the market, and that's been a prime example of the last 3 to 4 weeks. You get a headline in the morning, different headline in the afternoon, and the market rotates back and forth 2 or 3%.
And it's interesting that you say that, because those 3 to 4 weeks in between quarter seasons, it's just a vacuum
Yes.
of news, and there's nothing. Volume tends to be a little, well, it normally is a little bit lower, and these macro headlines is what drives the market. So I think with Q1 expectations high on the earnings side, I think traders, that's a welcome thing for them to not necessarily be so dependent on what's happening on the overnight or what's happening from a political perspective.
All right, we're going to get a clearer picture in a couple of weeks. We're going to see how these companies are doing for the first half of the year. We're focused on obviously June, the next Fed meeting, possible rate hike that way. We got a big employment report coming up as well. You want to see the trend in employment. Does it stay strong or does it start to weaken? We again have a lot of cross currents in the next couple of months that we need to pay attention to.
All right, well, thank you very much for joining us at MarketSite, and thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.